Hey, last week, the Federal Reserve raised the Fed funds rate by 75 basis points. And so I ask you, Brad C. of Kentuckiana Mortgage Group, what happened to mortgage rates as a result?
They went down.
They went down.
They went down.
By a not insignificant margin, right?
By a good amount.
Yeah. So that prompted Kentuckiana Mortgage Group to post on their social media pages a meme that says, repeat after me, the Federal Reserve does not directly impact mortgage rates. So as simply as you can possibly explain that, what does that mean?
It's not apples to apples.
Not
Rates don't go from 5% to 5.75 when the Federal Reserve raises the interbank rate by 75 basis points. That's just, it has an impact, positive or negative, depending on what they do, but it's not one for one.
Yeah. Okay. Well, so that's why I brought you in today. This is Brad C., Kentuckiana Mortgage Group. He's our Southern Indiana local mortgage expert. So why do you listen to this video? We want to talk to you about what the Federal Reserve did last week, how it impacts mortgage rates, if at all, and how that impacts a borrower, especially someone that's looking to buy a home. If you're looking in the market right now, or if you ever plan to buy a home or sell a home, this information will be important to you. So Brad, thanks for joining us. Look, if the Federal Reserve doesn't directly impact the mortgage rates, we want to understand what does so we can educate our clients. And so I want to take us through an article written by Bankrate.com that explains, hey, here's 5 factors that impact mortgage rates. So let's take a look at that article. We'll walk through the points together. Okay, so here's the article from Bankrate.com. It was written by Jeff Ostrowski. Hopefully we're pronouncing that right. I did copy and paste that over to a Google document so I can make some highlights here. But Brad, let's start off with kind of where rates were before the announcement, what they did after the announcement, and then maybe where they're at today.
Yeah, so before the announcement, we were kind of in the, as far as like 30-year fixed conventional, which is kind of the, the baseline that everybody kind of uses. So, I would say we were seeing rates in the mid 5s. And really after that announcement, they got, almost 0.5% better as far as rates go and got close to or at 5%. We were able to see some people at, even 4.875 or 4.99.
Yeah. So, and that's what we were seeing. Daily Mortgage News Daily had it drop down to 5.05. So like you said, almost a 0.5%. And then what are you seeing on rates as of today?
So yesterday was a little bit of negative movement. So rates kind of moved back a little bit, maybe up 1/8, but not a major movement yesterday. We'll, see what today holds. But as of today, August 4th, still a lot better than they were 2 weeks ago. Yeah.
So a lot of experts were anticipating wrongly, and I don't know, maybe it's just the media experts. They were anticipating that 75 basis point Fed funds rate hike would directly impact mortgages and we'd be back up over 6%. That did not happen. So again, Jeff Ostrowski in this article, he gives us 5 things that he believes impacts the mortgage rates. And so let's walk through those 5. Oddly enough, he starts with number 1. It begins with the Federal Reserve, and then in parentheses, he has sort of. He says the Federal Reserve doesn't set mortgage rates, but the central bank's decisions definitively or definitely influence mortgage rates. So talk to us about what impact the Federal Reserve has and why.
So the Federal Reserve, what they do with interest, what they do with their Federal Reserve rate is manipulate the rate that banks lend money to and from each other. So it's really short term. So we're not looking at, 10-year bonds or 30-year fixed mortgages, but what they do has an impact on investor confidence and what investors do as a whole with the economy. And so it does have an impact, but depending on what they do and how that impacts investor confidence, rates could go up or down, regardless of what they actually do.
Yeah. Yeah. You nailed it. And what I told my clients is, hey, look, it wasn't what they did per se. It's what they said in the statement after. And the Fed chairman in the statement said, look, we feel like the economy is starting to suffer the consequences. These are my words, not his, but essentially suffer the consequences of previous rate hikes and the one that we have here today. So we think there's probably going to be a turn, which is really what I think caused rates to drop. Any thoughts there?
Yeah, I don't disagree. I think the things that I have, read and seen, it's more that the Fed is doing what's needed for the economy, which gave the investors confidence, which is ultimately probably why rates went down.
Yeah. Well, and this other quote I have highlighted in this section says, because mortgages are packaged together into securities and sold as mortgage bonds, who are they sold to? They're sold to investors, to your point. It's the return investors demand to buy these bonds that dictates the general level of mortgage rates. And the Federal Reserve does have impact on that. And again, to your point, does dictate the confidence of the investor. So let's look at number two. So Federal Reserve, sort of. Number two, economic conditions play a role. And he says here, what happens in the economy and how those events affect investors' confidence, there's your words, influences mortgage pricing. And he goes on to have this thing, bad economics versus good economics. So thoughts here on economic conditions?
Yeah, this year has been kind of all over the place. And so we've seen that in interest rates where a couple, 2 months ago, we hit kind of in the sixes, in the low sixes as far as average 30-year fixed rates. And then all of a sudden we're down to 5.5 and then down to 5 and then back to 5.25. It's honestly, it's a little unpredictable. And I think that's because the investors have confidence and then they lose it, and then something happens and they gain it again, and it's back and forth with week to week or even day to day in some cases.
Yeah, day to day. And that's the thing, we've just seen all of these data points come in. Some of them are good and looks like we're going to be back on track, and then we have something else that comes in that disrupts things. The author here, he says bad economic news is often good news for mortgage rates, and then lower down, good economic news is bad for mortgage rates. In the way that I've phrased it, that makes more sense to me is strong demand is going to drive up rates, whereas weak demand is going to draw them down. I don't know if you have any thoughts on that.
Yeah, no, I don't disagree with that at all. And as far as economic conditions go, it's weird that things that can have an impact. There's some people that think that the Speaker of the House, Nancy Pelosi, going to a foreign country that China thinks that they own was made investors nervous, and that was maybe had partial of the little uptick in rates the past couple of days.
Yeah. So economic conditions, they play a role. I think the key thing that you said, Brad, is it's unpredictable, right? And we're going to come back to that. It's unpredictable, changes daily. So to try and time that is a loser's proposition. Number three, and this is a big one that has been plaguing our economy for many months now, and that's the rise of inflation. He says here, rising inflation limits consumers' purchasing power, and that's a consideration lenders make when setting mortgages. Thoughts on inflation?
Yeah, inflation is bad for rates, right? At the end of the day, the cost to originate and do mortgages, and lenders do have fixed costs to do what they do, and it has an impact across the board.
Yeah, so inflation is a rising tide that lifts all ships in a sense, whether it's grocery prices, electronic prices, car prices, and even mortgage prices. If inflation is on the rise, generally you're going to see mortgage rates rise. But again, a lot of factors that go into it. Let's look at number 4. There's a chart on inflation. We can just see that massive run up over the last year and a half to 2 years. Number 4 is your financial and credit picture. Brad, I think this one's important because the first 3 are things that people cannot control. They're out of the control of the home buyer. Your financial and credit picture is something that borrowers can control. Talk to us about this, and what are lenders looking at in regards to financial picture of the home buyer?
Yeah, so everything's a layer of risk. So when you're looking at your financial and credit picture, one of the things that we're looking at is your credit score. For all mortgages, we pull all 3 credit bureaus, use the middle score. If there's multiple people, it's the lowest of everybody on it. And that puts you in a certain bucket. And if you're, on the lower end of the credit spectrum, your interest rate is going to be a little bit higher because that is considered a little more risky. But if you're on the higher end of the credit score spectrum, you're going to get, the best rate we can get today, depending on what the 3 things that we just talked about. We can't control those, but on any given day, if you're in a good credit situation, you're going to get the best rate that's available out there.
Yeah. Brad, can you give us a sense of what that spread is? If you've got someone with, well, let's say a really good credit score and really good financials versus someone who's just making the cut of qualifying.
Yeah, as far as conventional loans go, it could be as much as 0.5% on interest rate. So it can be a pretty big deal. You're looking at maybe $100 to $150 a month more on a monthly payment, depending on loan size and, a million other factors that we could talk for an hour on. Yeah. But it can have a significant impact on your interest rate, which will impact your buying power as well.
Yeah, impact the buying power is huge. And even though that monthly payment, 100 to 150 a month, doesn't sound like a big deal, that translates into tens of thousands of dollars over the life of a 30-year mortgage. Hey, we've done some videos on this, and we'll link to those about how people can improve their credit score and their financial picture. But can you give us 1 or 2 things that people can do today to improve their chances of getting the better rate?
So obviously the one is on-time payments and having open active accounts. But the biggest thing you can do immediately, or maybe not immediately, but as you plan to buy a house or whatever, is to get the credit card balances down. So and it's not necessarily like the balance, but it's the percentage of the balance. It doesn't matter if the credit card has $1,000 limit or a $10,000 limit. Once you get over that kind of 20% of whatever that available is, it starts to have a negative impact on your credit score. So if you're looking at buying, if you can get your credit card balances down compared to the max limit, that'll have the biggest and quickest impact on credit score.
Yeah, great. And yeah, Brad, you're so good at educating clients on that. Again, we'll post links to those videos where you go into more depth. The key is Brad C., Kentuckiana Mortgage Group. Brad, you've been doing this a number of years, both in good economic times and bad economic times. You cannot control the Federal Reserve. You cannot control inflation or economic conditions. You can control these things to improve your rate by, in some cases, up to 0.5%. So it's a key thing for clients to look at. Let's look at number 5, origination costs. And you alluded to this earlier. Lenders need to be able to keep the lights on. And so he says, the final item on our list is not about the economy or the borrower, but it's about the lender's bottom line. Brad, what's he talking about here?
So lender's bottom line is basically how much it costs them to originate and do a mortgage, because they have staff and managers, and there's processors and underwriters and teams that manage taxes and homeowners insurance. And lenders have all these people that work for them, like doing all these things, because a mortgage application in the process is a bunch of third parties. There's a lot of puzzles to get, a lot of pieces of the puzzle to get all together. So what this is talking about is the cost has risen to originate and do loans, which can have an impact on interest rate. And I think the most important thing here to talk about is margin. So margin, each lender can have or set their own margin. And the higher the margin, the higher your interest rate with them is going to be. So as these lenders in these tough economic times have all this overhead and staff, they may increase their margin, which in turn will increase your interest rate so they can help cover some of those costs.
Yeah. In fact, he does say that here at the bottom. He says the more efficient a manufacturer of mortgages can be, the more competitive they are on pricing. He talks about this isn't about the economy or about the borrower. I'm most concerned for my clients about things that they can control. And he says here at the bottom, here's the bottom line. When the demand for mortgages surges, lenders may have to account for more spike in the processing costs involved, more staff, more overhead that you talked about. They may have to hike mortgage pricing. When demand is flat or falls, lenders have to adjust pricing to attract business and keep the lights on. So again, the lender that you choose may have an impact, some on the rate, but even more on those costs of borrowing.
Mm-hmm.
And so he says this, shop around, compare lenders. And you're a lender. I hesitate to bring this one up, but does that bother you at all that he says, hey, you have some control over this, shop around? Does that bother you?
No, you should shop around. I encourage people to shop around and even shop us. When consumers shop and get lenders to compete, the consumer always wins at the end of the day. And so what I've seen over the past 6 months, if things have tightened up, is I've seen some lenders up their underwriting fee or add a $500 processing fee or whatever to try to make up for some of those costs, or that there's not as much business out there to go around right now that rates have kind of gone up to where they were a year ago. We've seen massive layoffs on some of the bigger lenders. But I think one thing, and not that we're doing it the right way and we've got it all figured out, but we're a small local office here in Southern Indiana. We don't really have overhead and debt or anything like that. So we're able to keep our margin exactly the same, no extra processing, no extra underwriting fee or anything like that. As we've moved into this tough time, we're not changing any of that.
Yeah. Well, to your credit, I've talked to lenders who say, hey, should clients shop around? Oh, the rate is the rate. The rate is the rate, the costs are the costs. They don't necessarily want you to shop around, but you can say with confidence, yeah, shop around, because I'm assuming you feel like you just said, you have the best available. You're not afraid that they're going to see something better out there.
I am really not. I'm very confident in our margin pricing and closing cost. Another thing that we do is we have two handfuls of lenders now that we shop for the client as well. So lender A maybe the lender A hasn't upped their margin or they haven't added any extra fees or anything, but lender B has. And so we'll go to we can take your loan to lender A. Or if lender C all of a sudden decides that they want to drop their rate and get some business in the door, we can send your loan to lender C. So we are actively shopping for you. So we credit, title, appraisal, we can use those across all of our lenders. So like I said, our margin's flat. It's the same across the board. Yeah. So we're going to get you with the lender that's giving you the best deal.
Yeah. Yeah. And not naming any specific names here, but if the lender that you're choosing has the word bank in it, they're not going to be able to shop it the way that you can, and they're probably going to have that more extensive overhead that's going to add to the cost. All right, Brad, I want to close out here with just a summary. Mm-hmm. We've got 5 factors that the author says, hey, here's what contributes to mortgage rates. In your mind, which one should borrowers pay the most attention to?
Their own personal financial health, or however you want to look at it, and it's not necessarily the, lower end or credit scores that may not qualify and try to get them to qualify. But there, like I said earlier, there's there's buckets for interest rates and pricing and how all this stuff works. So, taking a client that has a 699 paying, $100 on a credit score to give them to a 701 could have a 0.25% impact on their interest rate. So it's not necessarily if you have bad credit, you need to get good credit. You might have good or decent or pretty solid credit, but if you can get it up just a couple points, it could have a pretty significant impact on your mortgage financing.
Yeah, you may have a good credit score, but your financials, your DTI, debt to income ratio, yeah. So it's that's the most important one to pay attention to. I agree as well. You've been in the mortgage business for a lot of years. Someone who says, "Hey, kind of want to time this and see how things are going to play out before I buy or before I lock in my rate." What do you say?
We talked about it. It's just unpredictable right now. I don't think there's any way you can time the market. You could be waiting 4 years and rates still may be exactly what they are today, or hovering between 5 and 5.5. So you're playing with kind of, dollars here and not, thousands and thousands of dollars. It's I don't know. I think timing the market is just, every investment advisor anyway says, don't try to time the market.
Yeah. We started the year 2022 at what mortgage rate approximately for the year?
God, if I think back, I think we were in the mid to high fives, if I'm not mistaken.
So, but as recently as the last 12 months, we've been in the threes.
Exactly.
Yeah.
Yes.
Yeah. So for folks who said, I'm gonna wait a little bit, they've gone from somewhere in the low to mid threes to now in the mid fives. And that timing has burnt them as far as a mortgage rate, mortgage payment goes. Author of Bankrate.com article. This article suggests that people should shop around. We talked about that. You're in favor of it.
Absolutely.
Yeah. Just to summarize for us, just one last time. Why should people reach out to Kentuckiana Mortgage Group if they're looking to get a mortgage?
Again, it goes back to our, margin and how we do things and our speed and efficiency. I think that, you can read our Google reviews and find us on Facebook and read everything you want. But I really genuinely think we do a really good job, speed, efficiency, price, and rates. I don't know that we can be beat, but I'm sure there's somebody out there that might be able to. But at least give us an option, or at least give us a look. And we'll be honest with you. If we can't beat an option you're getting, we'll tell you, hey, that's a really good deal. You should go with that.
Yeah. Brad, I've read through a number of your Google reviews, and very few of them mention pricing. You do have great pricing, great rates, but most of them focus on the service that you provide, the education, the extra effort, even for those clients who are on the edge of low rates, bringing them up higher. You do a great job. So thank you as always for taking care of our clients. Brad C., Kentuckiana Mortgage Group. There are 5 factors that can impact how mortgage rates move. Repeat after me. The Federal Reserve does not directly impact mortgage rates. Brad, thank you so much for joining us today.
Yeah, and I appreciate you, Mike, and thank you for the kind words. It means a lot and humbles me. I appreciate it.